All right, just to reset, the European debt problem is a deflationary issue that is exported to the United States by the rising dollar exchange rate. That is pushing down commodity prices, and it may be interrupting the recovery with a soft patch. There are other issues, but the Fed was talking deflation in their statement today. We haven't seen that in quite some time. We're back with Rick Santelli, Vince Reinhart, Jim LeCamp, Jim Iuorio, and Lee Munson. Jim Iuorio, I want to ask you if profits show up soft. Now, this is one of my concerns because we're in a little bit uncharted waters here with this deflation of commodities and the dollar deflationary pressures. If profits show up soft, the roof could cave in on the stock market. This is what really bothers me. I want to get everybody's take on this, but let's start with you.
Yeah, no question about it. And if that happens, that's the shock to the system. There is a wealth effect out there. I mean, the consumer is hurting, but as long as the stock market stays somewhat buoyed, I think the consumer feels pretty good. If that starts to reverse, I think it becomes disastrous. But about the things you talked about before, too, this thing is all really about job creation. And we talk about getting money to the small business. You can't get money to the small business if you keep adopting this adversarial relationship with big business. And until they walk from the left to the center and stop that policy, none of these companies are going to want to hire people, and people without jobs don't buy homes. So, yes, the profits thing is going to be a big issue, and when that happens, the whole thing could cave in itself.
You know, Rick Santelli, I mean, look, it's like a lot of things in life. You can complain, but you don't get anywhere. But nonetheless, Rick, one of the reasons I don't want the Fed to keep printing money is that I think the problem is a tax problem and a regulatory problem. Why is it, Rick, that Wall Street always instinctively says, oh, if the economy's soft, the Fed should print more money? I don't agree with that. I think these problems are we've lost free enterprise. We've lost a lot of opportunity in our economy, Rick.
You know, the 1930s, we have a Fed chairman who's an expert in the 1930s, and I will still contend that the raising of rates towards the end of the 20s wasn't what caused the Depression. What caused it was the 7 years prior to that in the Roaring 20s where money was too cheap, which is exactly the same problem now. And deflation, you know, you have to make the deflation the demon, Larry. Otherwise, you don't get away with printing money. And I want to ask you something very simple. When we have a bout of falling prices, who gets affected more, the wealthy or the average?
Oh, listen, actually, falling prices probably hurt the average Joe, the average Main Street worker.
See, I would think that the really wealthy would suffer more in a deflationary environment. And I would think in an inflationary environment that the average Joe would suffer a little bit more. Just my own thoughts.
It has to be a serious, okay, if it's a significant deflation, yes. We don't have a significant deflation. No. I mean, look, we can put this commodity chart back up on the full screen, the raw material. It's off 20% from the peak, but it was up, I don't know, 60 or 70%. We have disinflation, i.e. 2% inflation or 1.5% inflation. I mean, that's not a collapse of commodities. I mean, Vince Reinhart, Rick makes a good point. I mean, inflation does hurt everyone the most. I agree. But what I'm saying is deflation, people who have debt get hurt by deflation. People who have debt are helped by inflation. Debt is a problem. Now, I want to ask you, why is the Fed so keen on painting a deflationary scenario? What's up with that? Does that mean they really want to print more money?
No, I think they're really just conveying the message that they'll keep the policy rate at an exceptionally low level for an extended period. They're just trying to convince everybody they're not going to tighten anytime soon. They did, you know, they're focusing on underlying inflation trends. What's that? I don't know if anybody knows. They're just trying to say, let's not look at the high-frequency movements. Inflation is trending lower. That's a problem, but they'll keep their policy rate low to offset
All right, so Jim LeCamp, let me come back to you. I want to make sure I get this right. Are you buying treasuries in gold? You agree with what I'm going to call the Iuorio trade? Are you buying treasuries in gold to the exclusion of everything else?
Gold is our heaviest position in our portfolio. We own the gold ETF, and we own several of the gold mining stocks. We don't own the treasuries, but I do think interest rates are going lower, and I have no problem with somebody wants to buy the treasuries. Getting back to the deflation argument, deflation is a natural result of an economy that gets way too levered and has no way out. That's what's happened in the United States and around the world. So deflation is a very serious
threat. It's a healing process, right? It's healing.
Yeah, the concern I have, the concern I have is that we have a Fed a Fed chairman that believes in money printing and doesn't understand why gold is going so high. I have a serious issue there because gold is going so high because of all the money printing problems, and the world recognizes that this is going to have a bad end one way or the other.
Well, so, Rick, you know what? Sometimes markets have to run their course, don't they? The adjustments have to occur. Let market forces do it. It's like housing. We're going to have more price clearing. We're going to have more sales clearing. The more the government intervenes, the longer this process is going to take, Rick. Is
longer
that fair?
and more expensive. Exactly. You nailed it. Listen, it's not going to be easy. Even with all the money we've spent, and I don't think we've done it appropriately, we haven't got good return on it, I still see pain in the future. We need to tighten our belts. We're going to have to adjust the spending side, and it can't all be the VAT tax solution, because I don't think Americans are ready for VATs. We don't want to turn
you got to have some pro-growth
Rick,
policies. You got to kick in some growth policies, too. Targeted tax cuts, lower the corporate tax rate, lower the capital gains rate.
That's too easy.
I think you guys got it.
Those kinds of pro-growth supply-side policies are much too easy. They don't want to do that in Washington now because they have a lot of Ivy League experts that say don't do that. Did you see Steny Hoyer, the number 2 person in the House? All right, he's a good man. He just said yesterday they are not even going to
budget. No budget.
He said, we can't cut spending like this to deal with the deficit. We're going to have to let the whole Bush tax cut run off. Not just for the upper end, which is bad enough, but all middle-class people are going to take a huge tax hike. That, according to Steny Hoyer.
Well, not only that, Larry, that same article, Steny says no budget. We get a budget resolution. No budget till December, which happens to be after November, isn't it? I think it is.
Yeah, sure. Why not? Let's wait until after
By the way,
I think you guys got to take a step back for a second.
Lee Munson, are you buying the emerging markets? Because this is a little piece here, all right? China, India, Brazil, the Asian currencies have gone up with the Chinese yuan announcement. That seems to be the biggest source of growth. It's not Europe. It's not the United States, Lee. Is it worth going back in? Is it worth buying China? Is it worth buying the other Asian countries? Is it worth buying the emerging markets right now? That's an important issue. Let's go back to that theme.
Let's take a step back, and I want to answer that, but I want you to connect a few dots. First of all, the 1115 level on the S&P 500 is key because it was last year's close. Until we start closing above that, no professional manager is going to feel compelled to buy anything, including emerging markets.
Well, we're at 1092.
Number 2, I think that you have to...
Will we ever see 1115?
I understand that. We need to start closing above 1115 to start getting people to get anxious. Number 2, I already mentioned you have to find the hiding holes of professional managers, and right now it's not China. I was talking to a client. He was talking about Asia because of 10-year growth projections. I told him, think about the next 10 months, because right now China is a 5-letter acronym for trade at long and short. 10 years, hope may spring eternal, but I think right now with this deflation of commodities, strong dollar, I still think you have to avoid that, find your spot. Larry, you're right. Just take 3 to 6 months off, look for some nice, strong U.S. dividend payers, and then go find your points.
I like that very much.
Find your points in China later.
My only add-on to taking 3 to 6 months off is, if you get these little mini stock market rallies, sell into them. Take profits at the lower capital gains tax rate before the IRS takes them next year. And then if we have regime change, when regime change comes in November, if that's the truth, Rick Santelli, if the Tea Party movement wins and I
heard you say if, Larry. It's not if. It's not if.
It's when. All right. When the Tea Party triumphs in November, we will all come back and get right back in the stocks up to our eyeballs. Gentlemen, you have been terrific. I can't thank you enough.